watching the price of a barrel of oil this morning as the U.S. sharpens its sanctions against Russia. It's now targeting two firms that manage more than a quarter of Russia's seaborne oil exports. Let's bring in Cole Smead, CEO of Smead Capital Management. Hi, Cole. Thanks for being with us.
Thanks for letting me join.
How critical are these sanctions the U.S. is bringing against these two Russian companies?
Yeah, it's a good question. I would not only talk about the sanctions that you're seeing here, but also over the last few weeks, some of the little less followed news has been the sanctions that are coming up tied to oil tankers also that are moving Iranian oil, for example. And I think those kind of subject matters are going to just get tighter. You know, there's a lot of hope that the war in Ukraine will end, and there could be good or bad reasons for that. But I just pointed out because what we're seeing today is supply is very tight. You're going to see on the futures curve right now what's going on is spot is firming and we're getting more backwardation, which is historically very bullish. And any commodity trading advisor or anything that's running short-term momentum in these markets are having to go from short to long. And so that's why you're seeing this spike today. And I think that's really where the market's been. They believe in glut, they think we're oversupplied, and they're waking up to the different reality of what's going on in the market right now.
Now, as far as energy consolidation, what do you make of that? We note that there was a deal today, Constellation Energy and Calpine, and markets seem to love that for Constellation. The stock is way up. Do you expect more of this? And why is it happening?
Yeah, you're going to see more merging where, things and call it the smaller mid-cap range, get bigger together. And then the other thing you're going to see is majors, particularly the U.S. majors, once the Hess issue gets settled with Chevron and Exxon, you're going to see that clear up for more consolidation on the U.S. side. I'm really kind of surprised right now, to be honest. The Canadian majors aren't doing anything. They've let their U.S. counterparts go out and consolidate their side of the border, but we're not seeing that on the Canadian side. But I think you will see that pick up. Some people at lower prices just don't want to sell because they're hopeful. But as prices pick up, you can see deals pick up because obviously they're getting better terms, and the acquiring entities also feel better about the cash flows they're taking. I think you're going to see stock deals because people want to take commingled risks in this subject, and that's what we're really going to see. But these prices are great. I think people can go out and buy in the open market, and I think a lot of the worries of the glut have priced in pretty dour circumstances. I'll use Cenovus as an example. Cenovus is priced very attractively for us. Okay, we like the price we're getting. Very few people are hopeful. They've done a great job allocating capital the last 3 to 4 years, and really beyond those deals, what we'll continue to press on with any management teams is buybacks, 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 buybacks. Why? The Canadian government takes part of our dividend. So does the U.S. government for anyone like us that are U.S. citizens. And therefore, buybacks, they don't get any of that. And we're much more interested in a tax-free transfer like that.
And lastly, Cole, could you explain something in your notes today? You're saying that investors are on the wrong foot in terms of the long-term cost of capital. The market is expecting none of what is going on today. And if we scare stock investors further, look out below on the S&P 500. What do you mean by that? Could you explain?
Yeah, 10-year returns on the S&P 500 are going to be terrible. Terrible being they're either going to be zero or plausibly negative. Okay, now use a day like today. No one's believing that inflation will rear its ugly head, and then no one believes the long-term cost of capital, say the U.S. 10-year Treasury, will be higher. And that's exactly what we're seeing manifest itself in the bond market today. So if you're a stock investor, you're watching stocks go down, and bond investors are waking up to the reality of longer term structure price going up and or inflation plausibly being out there. Now, if you're an oil investor, in comparison, what's your cost of capital doing today as oil moves higher? It's going down. Okay, oil companies are not priced based on the 10-year Treasury. Stocks are, and so as oil prices go up and the 10-year Treasury climbs, you can make a lot of money while there's a lot of chaos in stock markets. That is a wonderful way to think about the arbitrage between being an investor in, say, the Canadian names or the U.S. names in the energy space versus what most stock investors are doing, which is passively owning American exceptionalism, which we don't think will be so exceptional at the end of the day.